Among all the assets discussed in books about wealth, stocks, real estate, businesses, and capital structures, there is one investment financial celebrities return to again and again, often without naming it directly. It is the only asset they all agree cannot be taken, diluted, or permanently impaired by markets. It is also the one investment most people delay until they feel ready. Investing in yourself. At first, the phrase sounds vague, even motivational. But when examined through the lived experience of financial celebrities, it becomes concrete, disciplined, and deeply strategic. This is not about self-help slogans. It is about building an internal balance sheet strong enough to carry external risk. Financial celebrities rarely begin with capital. They begin with asymmetry. Early in their lives, they possess little money but unlimited upside. Books reveal a consistent pattern. Before they invested in markets, they invested in capacity, skills, reputation, judgment, health, network. These are not soft assets, they are leverage. One of the earliest lessons these figures internalize is that money amplifies who you already are. If your skills are shallow, money exposes that quickly. If your judgment is unstable, money accelerates mistakes. Investing in yourself, therefore, is not preparation for wealth, it is protection against it. Financial celebrities learned this often through early failure, when a lack of internal structure made even small wins fragile. Education plays a central role, but not in the traditional sense. Financial celebrities are rarely defined by formal credentials alone. Instead, they invest obsessively in self-directed learning, reading, observation, apprenticeship, pattern recognition. They study incentives more than formulas, human behavior more than theory. The goal is not knowledge accumulation, but decision advantage. Another critical dimension of self-investment is skill stacking. Rather than becoming the best at one narrow function, financial celebrities combine complementary skills, communication with analysis, vision with execution, risk assessment with emotional regulation. Each skill multiplies the value of the others. This compounding effect explains why their influence grows non-linearly over time. Reputation is treated as an appreciating asset. Long before wealth arrives, financial celebrities guard trust aggressively. They meet deadlines. They honor small commitments. They avoid shortcuts that trade integrity for speed. Books repeatedly show that when capital finally becomes available, it flows toward those already known to be reliable. Reputation, built slowly, unlocks leverage suddenly. Another often overlooked area of self-investment is health. Financial celebrities do not treat physical and mental health as lifestyle accessories. They treat them as operating infrastructure. Energy enables patience. Clarity enables restraint. Endurance enables long-term thinking. Without health, every other investment becomes speculative. Many learn this lesson only after burnout, redesigning lives to preserve capacity rather than chase intensity. Time is another asset they invest in deliberately. Early on, financial celebrities prioritize learning over earning. They accept lower short-term income to gain exposure, mentorship, and experience. This choice appears irrational to observers focused on immediate payoff. In hindsight, it is the highest return investment they ever made. Time spent building competence compounds faster than money invested without it. Another insight emerges around identity. Financial celebrities invest heavily in separating self-worth from outcomes. This psychological boundary is critical. Without it, failure becomes personal, and fear distorts decision-making. By grounding identity in process rather than results, they preserve the ability to take rational risks. This is not emotional detachment, it is emotional design. Books also reveal how these individuals invest in environments. They choose where to live, work, and associate with intention. Proximity to thinkers, builders, and decision-makers accelerates learning. Environments shape defaults. Financial celebrities optimize defaults so that good behavior requires less effort than bad behavior. This quiet optimization compounds daily. Another area of self-investment is communication. Writing, speaking, and explaining sharpen thinking. Financial celebrities often write not to persuade others, but to clarify themselves. The act of articulation exposes weak assumptions. It slows impulsive thought. Over time, this habit builds intellectual honesty, a rare and valuable asset under pressure. Perhaps the most underappreciated investment is emotional regulation. Financial celebrities spend years learning how they react under stress. They observe triggers. They design routines. They limit exposure to noise. This self-knowledge prevents temporary emotion from causing permanent damage. In volatile environments, emotional stability becomes a competitive advantage. Importantly, investing in yourself does not stop once money arrives. It intensifies. As external leverage increases, internal weaknesses become more dangerous. Financial celebrities continue to refine judgment, expand perspective, and reduce blind spots. The richer they become, the more conservative they are about protecting their internal operating system. Another pattern emerges around humility. Financial celebrities who last remain students. They assume the world will change faster than their existing knowledge. Curiosity replaces certainty. This openness allows adaptation. Those who stop investing in themselves become rigid, and rigidity is expensive in dynamic systems. The contrast with popular narratives is stark. Many people believe wealth is built first, then self-improvement follows. Financial celebrities demonstrate the reverse. Self-investment creates optionality. Optionality attracts opportunity. Opportunity, when managed with discipline, produces wealth. And this is where the story begins to narrow. Because once we see that investing in yourself is not a vague ideal but a precise strategy, the hierarchy of priorities changes. Money becomes secondary. Skills, judgment, health, and reputation move to the foreground. It is at this point where the internal balance sheet is treated with the same seriousness as the financial one that the lesson from financial celebrities becomes unavoidable. The most resilient asset you will ever own is the version of yourself that can adapt, learn, and decide under uncertainty, compounding quietly year after year, independent of markets and cycles, carrying every other investment on its back, unfolding not as a motivational concept, but as a disciplined, lifelong allocation of time, energy, and attention, like unfolding not as a motivational concept, but as a disciplined, lifelong allocation of time, energy, and attention, like compound interest working silently beneath the surface of every external success. And this is where the lesson of investing in yourself, as practiced by financial celebrities, reaches its most decisive conclusion. In the second half of this story, self-investment stops being preparation and becomes maintenance. Financial celebrities discover that once money, influence, and responsibility arrive, the cost of neglecting the internal system rises sharply. Small weaknesses that were once tolerable become structural risks. A lapse in judgment now moves markets. A moment of emotional reactivity now damages reputation. The stakes expose everything. One of the clearest insights at this stage is that self-investment shifts from acquisition to subtraction. Early careers reward adding skills, contacts, and opportunities. Later stages reward removing distractions, commitments, and ego traps. Financial celebrities learn that clarity improves faster by cutting than by adding. They simplify schedules. They narrow focus. They say no more often than yes. This subtraction preserves decision quality when volume and noise increase. Another defining realization is that learning never becomes optional. Markets evolve, technologies shift, incentives change. Financial celebrities who stop investing in learning begin to rely on outdated maps. Those who endure remain intellectually flexible. They read outside their domains. They engage with younger thinkers. They question assumptions that once made them successful. Curiosity becomes a form of insurance against obsolescence. Self-investment also becomes more private over time. Early growth is often visible: courses taken, mentors sought, skills acquired. Later refinement happens quietly. Reflection replaces instruction. Experience replaces theory. Financial celebrities spend more time reviewing decisions than making new ones. They revisit mistakes not to punish themselves, but to extract durable insight. This reflective loop compounds wisdom in ways no external asset can. Another critical dimension is ethical alignment. As influence expands, the gap between what one can do and what one should do widens. Financial celebrities invest heavily in defining personal boundaries, what they will not do, what they will not profit from. These constraints reduce moral stress and protect long-term trust. Integrity, at this level, is not virtue, it is risk management. Health investment deepens as well. The body becomes a finite resource carrying infinite responsibility. Financial celebrities design lives that support longevity rather than intensity. Sleep, movement, and recovery are defended with the same seriousness as capital reserves. They understand that no portfolio survives a broken operator. Physical sustainability becomes strategic. Another insight emerges around mentorship, but reversed. Financial celebrities begin to teach. Explaining ideas to others clarifies them internally. Teaching exposes gaps. It forces coherence. This outward investment reinforces inward structure. Many describe this phase as unexpectedly rewarding, not financially, but cognitively. Knowledge, when shared, stabilizes. The relationship with money itself also changes. Money stops being a scorecard and becomes a tool. Financial celebrities invest in themselves by redefining enough. Once enough is clear, pressure decreases. Risk-taking becomes intentional rather than compulsive. This clarity frees attention for higher quality decisions and more meaningful pursuits. Importantly, self-investment also includes preparing for irrelevance. Financial celebrities who endure do not cling to prominence. They plan for succession. They design roles that allow withdrawal without collapse. Letting go becomes a skill. This acceptance protects identity and prevents destructive overreach late in careers. As cycles repeat, one truth becomes undeniable. External assets fluctuate. Skills compound. Markets punish arrogance. Judgment rewards humility. The people who remain standing through multiple cycles are not those who predicted best, but those who invested continuously in the only asset that adapts faster than the world changes themselves. And so the lesson resolves into something both simple and demanding. Investing in yourself is not a phase. It is not a response to insecurity. It is the primary allocation strategy that makes every other investment viable. Financial celebrities did not succeed because they were extraordinary at markets. They succeeded because they treated their own capacity as the most important portfolio they would ever manage. If this reflection resonated with you, pause and ask yourself one question. What part of your internal balance sheet skill, health, judgment, or integrity would most benefit from investment right now? Start there. Share your thought. And if you want to continue exploring how real wealth is built from the inside out, stay connected. Subscribe, follow, and return. Because long after markets change and trends fade, the best investment you make is the one that keeps paying you back for the rest of your life.